Hello everyone, so today we are going to talk about crisis and responses. But before we continue to the presentation, let me introduce our group members. There are Daniel Alexander, Viola Kanno, and Valerie Fabiolette. I will start by explaining types of crisis. So the first one is hyperinflation. Have a characteristic a rapid increase in the overall price level of a country, typically defined to be 40% or higher on an annual basis. The example is the crisis in Zimbabwe between 1998 until 2009. So it began in the late 1990s. The Zimbabwe government introduced a series of land reforms. This involved redistributing land from existing white farmers to black farmers, but with a little experience, the new farmers struggled to produce food, and there was a large fall in production. And because of that, the economy experienced a sharp fall in output in both agricultural and manufacturing, and this caused a collapse. Because of that decline in economic, the government decided to print more money, but unfortunately, the crisis get worse, and then the national debt increased, and because of that, they decide to print more money again, but it give a negative impact due to excess of money supply and excess of the growth in real GDP. So basically the crisis in Zimbabwe occurs because of an increase in money supply in excess of the growth rate of real GDP. And the second one is balance of payments and currency crisis have a characteristic large devaluation or rapid depreciation in the value of a domestic currency in response to balance of payments difficulties. It happens in Mexico and Brazil. So these crises have a correlation with hyperinflation. The reason is significant degrees of inflation occur. Asset owners move out of domestic currency to foreign currency asset in order to maintain the value of portfolio. This is give a negative impact to the domestic currency and puts downward pressure on the value of domestic currency. Because of that, the domestic currency depreciate and foreign currency appreciate. The third one is asset price deflation, with the characteristic a sustained and large decline in the prices of financial assets. It happens in Japan and United States. So the assets deflation crisis in Japan occurs because of the mistake from Bank of Japan. At that time, they increased the interest rate, and it gives a negative effects to bursting of equity and real estate bubbles. And since the land prices fall, the Bank of Japan start to cut the interest rate, but unfortunately, the liquidity trap already occurs. So basically, people and investors don't want to spend or invest anymore because they believe the goods and service will be cheaper for tomorrow, so they don't want to invest anymore. Next is banking crisis, with characteristic the occurrence of bank runs and or the merger, closure, or government takeover of banking institution. It happens in Argentina in 2001. The banking crisis in Argentina was caused by the lack of coordination between monetary policy and fiscal policy, which lead to the collapse of the banking system. So the mismanagement of the policy lead to the rise in tax rates that only reduce domestic demand and encourage corruption and did not lead to the necessary reduction of the fiscal deficit. This causes the government unable to control the local expenditure and the pacification of bank deposit and loans at the two different exchange rate caused a wave of defaults and liquidity problems at Argentine company. So the default rate of rated issuers was even as higher as 60%. And then the Bank of Argentina could not prevent this problem, including both domestic and foreign banks from being affected. They cannot prevent this problem because the bank experienced a loss due to the bankruptcy of many banks' debtors. Next, external debt crisis have a characteristic sovereign default on debt obligation to foreign creditors or substantial restructuring of this debt. The example in Mexico during 1982. So the external debt crisis in Mexico began in 1980s with a significant increase in real interest rates and a significant decline in non-oil commodity prices. This increased borrowing costs and reduced export revenues for many developing countries, including Mexico. So this causes Mexico unable to service its external debt obligations. And after years of accumulating external debt, it raises the world interest rates and the worldwide recession and sudden devaluation of the peso causes the external debt payments to rise sharply. And the last one is domestic debt crisis. The characteristic is the same with external debt crisis, but the difference is for the external debt crisis, it is from foreign creditors, but in domestic debt crisis, it refers to domestic creditors. So the examples in Argentina in 1989. It occurs because of inflation that increased the national debt or domestic debt, which lead to a domestic debt crisis. For the next slide, we'll explain by my friends.
Hello everyone, my name is Daniel and today I'm going to be explaining about contagion and system risk. So what is contagion? It is the case where crises that begin in one country spread to another country. So as stated by Kaminsky, Reinhardt, and Feg, some financial events trigger an immediate and startling adverse chain reaction among countries within a region and in some cases across region. So the examples of contagion is the first one, we have the spread of the 1994 until 1995 Mexican crisis to other countries in Latin America became known as the tequila effect. And then the spread of the 1997 crisis in Thailand to other countries in Asia, becoming the Asian flu or the crisis of Asia. So to understand the notion of contagion, we need to consider what exactly is transmitted across national boundaries. So there are a variety of possibilities, differing opinions among specialists, especially in international finance. And one thing to note is that contagion does not always occur in episodes where we might most expect it. For example, Kaminsky and Reinhardt and Weg, they noted that there are lack of contagion accompanying the 1999 devaluation of the Brazilian real and the 2001 demise of Argentine currency board and the 2001 devaluation of Turkish lira. And yeah, as you can see that these countries was very large and they were the important emerging markets, and yet there's lack of contagion from the crisis in these countries. Kaminsky, Reinhardt, and Feg identified three causal factors that contribute to episode of contagion. The first one, sudden stops in capital inflows, surprise announcements to financial markets, highly leveraged financial institutions. Furthermore, Joyce and Nabar showed that sudden stops interact with banking sectors to cause banking crisis. So we can conclude that sudden stops, banking crisis, and contagion can all be related to one another. So how can actually a country government can shield themselves from contagion? So they can do this by avoiding overborrowing that can accompany pro-cyclical fiscal policy in open capital markets, continuous information sharing, prudential regulation of financial markets, and market-friendly capital controls. Systemic risk. So at times, contagion spreads so rapidly and to such an extent that it becomes global, affecting the entire world financial system. So this is also known as systemic risk, which is also a rare global event. Golden and Fogel strongly suggested that there has been an increase in systemic risk due to the process of financial globalization. So next I'm going to be explaining about analyzing balance of payments and currency crisis. So this topic we're going to be focusing ourselves on analyzing the exchange rate dynamics behind the possibility of a balance of payments crisis ensuing when the capital account can no longer support a current account deficit. So first of all, let's assume ourselves to be a Mexican investor and our home country is in Mexico and the foreign country is the United States. So let's suppose that Mexico is successful in implementing an equilibrium exchange rate at E0. So if you recall from the previous chapters that this equilibrium exchange rate requires that E in the power of E equals E0. That is, the expected future exchange rate must equal the equilibrium rate. So in turn, it also requires that the interest rate on the peso must equal the interest rate on the US dollar, or RM equals to RUS. Okay, so let's suppose that we find Mexico in a position of current account deficit, which was the actual case for Mexico in the early 1990s. And such a current account deficit is always financed by the capital account surplus. However, in Mexico's case, in early 1990s, the capital account surplus was primarily in the form of short-term portfolio investment, much of it denominated in dollars. So let me tell you what happened if when a large trade deficit is financed by an inflow of short-term capital. So if that happens, it means trouble. That is that it was denominated in foreign currency, which is the US dollar. It made the trouble worse because any fall in the value of the home currency would inflate the domestic currency value of the debt. Many domestic investors back then were aware of these problems and began selling pesos and buying the US dollars instead. Okay, so let's pretend that we are the Mexican investor. And if we feel that the Mexican government will have to devalue our peso in order to suppress the trade deficit, then in our mind we will have E in the power of E is larger than E0. And when this occurs, the interest rate parity condition would come into play. If RM is equal to RUS and in the E in the power of E is larger than E0, then the following equation is true. So let's take a look at that a little bit further. Okay, so this is the same equation. So on the left hand side, as you can see, RM is the expected total rate of return on peso denominated asset, while the other one is the expected total rate of return on dollar denominated asset. So basically similar to what happened back then, Mexican investors were aware of these problems and they began to sell pesos during 1994. So that will happen in our condition too. So we will adjust our portfolio. We will buy dollars and then we will sell pesos based on this condition or this circumstance. And this is also known as capital flight. And yeah, just like I said, Mexican investors engaged in this type of portfolio reallocation during the crisis. Now let's focus on the graph on the right hand side. Um, the situation is actually resembled by this graph. So the change in expectations shift the demand for pesos graph to the left. At the original exchange rate of E0, the total expected return on dollar-denominated assets exceed the total expected return on peso-denominated assets. So basically, the equilibrium value falls. So, in response to these changes, in December 1994, the Mexican government devalued the peso by 15%. And based on the current situation, the demand also falls, shifted further to the left, and Mexico was forced to let the peso float. Beginning in February 1995, international investors began a sudden and massive portfolio shift out of peso denominated assets, sending the peso into a deep fall. So that's basically what happened um, to Mexico in 1990. So now let's talk about the Asian crisis, which happened in 1997, specifically in Thailand, with current account deficits amounting to nearly 8% of GDP under a fixed exchange rate regime. So the harsh part is most analysts at that time expected that the baht would fall by 15 to 20% in value against the dollar. So what actually happened was that it fell by more than 50% in value against the dollar. So let's take a look at the summary of what happened. So the crisis occurred when banks and financial companies borrowed heavily on a short-term basis from banks in other countries, mainly in Japan and the United States, and made overly risky loans to finance the construction of commercial and residential units. So when the demand for such units was not forthcoming as expected, a domino effect would occur. The real estate investors who borrowed defaulted, their lenders defaulted, and the banks were left with foreign currency denominated loans requiring payment. A subsequent foreign exchange crisis followed the collapse of the real estate market. These characteristics are what led to the loss of confidence in the Asian financial sector. And this loss of confidence in turn causes capital flight and balance of payments and currency crisis ensue. And by the end of September 1999, this Asian crisis was spreading to Malaysia and Indonesia. And Indonesia having current account deficit that was less than 4% of the GDP. And from there, the crisis spread to the Philippines, Hong Kong, South Korea, and Taiwan. Only the Hong Kong dollar escaped the devaluation. Basically, Hong Kong survived at that time. So now let's take a look at the figure on the right hand side. So the figure plots the nominal exchange rates for four of these countries, which are Indonesia, South Korea, Philippines, and Thailand, for the years of 1995 to 2005. So as you can see on the figure, that the largest decline in value occurred in Indonesia, where the nominal exchange rate increased by a factor of 4.5, while other countries experienced the same, but much less for the increase of the nominal exchange rates. So, what we can learn basically on this discussion is that banking sector was the main culprit. Banking sector were a central part of the Asian crisis. So I guess that's my explanation or my presentation. I hope you enjoy the presentation. I find it useful. Thank you very much for listening.
Hello everybody, my name is Putu Kanno and I'm going to present the next part, which is the IMF response or the International Monetary Fund response. So the IMF response to the 1997 Asian crisis and the 1999 Brazilian crisis became a point of serious contention and debate. We can characterize the IMF policies as consisting of three elements. The first is interest rate increases, and the next is fiscal austerity and structural reforms. Some observers suggested that these policies had been blindly transferred from the IMF programs in Latin America to Asia. So in chapter 15 and 16, the discussion of the interest rate parity condition said that an increase in the domestic interest rate will tend to increase the equilibrium value of a country's currency. The problem with this policy with being applied in the Asia and Brazil was that increases in domestic interest rates also tends to suppress domestic investments and push debt-burdened firms, including the banks, into default. And this in return sometimes led to a sense of panic. The IMF's fiscal austerity requirements were strategies to increase the government savings. In the case of Asian crisis, this strategy was probably misguided both economically and politically, and the fiscal austerity measures ignored the fact that the Asian crisis was not the result of the profligate. Structural reforms, which refers to the economic policies change outside the fiscal and monetary realms, had two weaknesses. The first is they are overly broad, and the second is they encroached on the traditional realm of the World Bank. The subprime crisis of 2007 to 2009. Financial crises can and do occur in developed or high-income countries. The causes of crisis in developed world are not much different from those of the developing world. The causes can include capital inflows, financial liberalization, asset price inflation, and overborrowing. The subprime crisis first emerged in the United States in 2007 to the 2008. It involved subprime mortgages that had been bundled into mortgage-backed securities or the MBS, and the buyers of these securities was distributed around the world. Losses in US housing markets were transmitted around the globe via a pyramid of financial instruments, including the MBS. This was the result of banks taking loans that would traditionally have remained on their books, repackaging them in the form of asset-based securities, and trading these securities internationally. Thereby, a crisis originating in one country took on a global profile through the systematic risk described above. Addressing this crisis had profound fiscal impact for the United States that have not yet been adequately addressed. It's also sparked the crisis in Europe that will be discussed in the next chapter 19. Basel Standards. The central bank heads of the Group of Ten established the Basel Committee on Banking Supervision in 1974. In 1988, the Basel Committee introduced the banking capital measurement standard known as the Basel Capital Accord, and later in Basel I, you can see in the table 18.2, which is here, in Basel I, they proposed a regulatory capital requirements of 8% as well as a framework for measuring the credit risk. And in 1999, the Basel Committee began to develop a revision of Basel I that became Basel II, based in three pillars. These three pillars are minimum capital requirements, supervisory review, disclosure for market discipline. In the Basel II, they recognized that Different asset classes involve a different level of risk and develop complex procedures for taking these risk differences into account in the first pillar. This Basel effectively reduced the capital requirement and allowed asset measurements to be risk-adjusted by banks' internal models. As the crisis of 2007 to 2009 testifies, Basel II was an utter failure, and the Basel Committee began to try again, and this time in the form of Basel III that was announced in 2010 and improved the asset risk adjustment and increased the capital requirement into 7%. Capital control. During the Asian crisis of 1997, the IMF considered adopting the full convertibility of capital accounts as a goal to be enshrined in a new article of agreement. The international economics became severely divided over the wisdom of this proposal. We need to consider 2 points. First is there are many different potential kinds of capital controls, and then there is a capital controls that can be tailored to different components of the capital account. And in 2010, the IMF staffs acknowledged in an important paper the potential wisdom of market-friendly capital controls. For the conclusion, financial crises come in many varieties. Just the hyperinflation, balance of payments and currency crisis, asset price deflation, bank crisis, external debt crisis, and domestic debt crisis can combine in ways in which one crisis makes another more likely and more sustained. Balance of payments and currency crisis can put pressure on an entity that holds foreign currency denominated debt that consequently increases in domestic currency value. Balance of payment and currency crashes can worsen the inflation by increasing the price of trade goods and asset price deflation. In the face of large changes in the expected future exchange rate, a government can have a very difficult time supporting in the fixed rate. So a weak financial systems add the likelihood of high-tech crisis where the confidence in the financial system deteriorates. There are now a new Basel Committee standards in the form of Basel III to hopefully make a systematic crisis like 2007 to 2009 less likely. Market-friendly capital controls can also play the role and have been finally endorsed by the IMF. Better data on sovereign debt and asset prices can also help sound the alarm on future crises. I think that's all from us. Thank you.